Welcome to this explainer video on the Employees Deposit Linked Insurance Scheme, or EDLI. This scheme provides vital financial security to employees in case of unforeseen events, ensuring their families are safeguarded. Throughout this video, we will break down the key aspects of the EDLI scheme and EDLI manual, helping you understand its features, contributions, and benefits. Employees Deposit Linked Insurance Scheme, or EDLI, is a key social security initiative aimed at providing financial protection to employees. The Employees Deposit Linked Insurance Scheme, or EDLI, was introduced on 1 August 1976 by the central government. It is administered by the Central Board of Trustees, ensuring that the scheme operates efficiently and effectively. To support the scheme, a dedicated fund was established, managed by the officers of the Central Board of Trustees. This fund is specifically used to provide assurance benefits to employees, securing their family's financial future in times of need. The EDLI scheme, 1976, is applicable to all factories and establishments covered under the Employees Provident Funds and Miscellaneous Provisions Act, 1952. However, there are specific exceptions. The scheme does not apply to tea factories in the state of Assam or to establishments that have been granted exemption under Section 17, 2A of the Act. Additionally, any individual or class of persons who have received an exemption under paragraph 28 of the EDLI scheme are also excluded from this coverage. An employee becomes a member of the EDLI scheme if they are part of the Employees Provident Fund or an exempted Provident Fund. Membership under the EDLI scheme is retained for as long as the employee continues to work in an establishment covered by the Act. This ensures continued protection and coverage under the scheme throughout their employment in a qualifying organization. As per 237th CBT meeting, held in February 2025, if a member passes away within 6 months of their last contribution received, the EDLI benefit will be admissible, provided the member's name is not struck off from rolls. The Act mandates that employer contributions towards the EDLI scheme must not exceed 1% of an employee's basic wages, dearness allowance, and retaining allowance. Currently, employers contribute 0.5% of EPF wages, with contributions applicable only to wages up to a ceiling of 15,000 rupees. Employers are required to pay contributions for both directly employed employees and those employed through a contractor. Importantly, these contributions cannot be deducted from the employee's wages. Initially, the central government contributed 0.25% of wages, half of the employer's share, toward the insurance fund, but this provision was withdrawn as of 16 November 1995, with the deletion of Section 6(c)(3). Notwithstanding any contract to the contrary, the employer shall not be entitled to deduct the employer's contribution payable by him under this scheme from the wages of the employees or to recover it from them in any other manner. Under the EDLI scheme, an employee's nomination made under the Employees Provident Fund scheme, using Form 2(r), or under an exempted Provident Fund will automatically be treated as the nomination for the EDLI scheme. In the case of an exempted Provident Fund, the nomination or the designated person to whom the Provident Fund was paid by the Board of Trustees will be relied upon for the EDLI benefits. Under this scheme, the main benefit provided is called the assurance benefit. This benefit is applicable upon the death of an employee while in service. In such a case, the nominee or any other eligible person will receive this assurance benefit in addition to the Provident Fund benefits. The amount of the assurance benefit is directly linked to the average balance in the Provident Fund account. Historically, the calculation of the benefit has evolved. From 1 August 1976 to 28 February 1990, the benefit was based on the lower of the employee's membership period or the 3 years preceding the month of death. However, from 1 March 1990 onwards, the benefit is calculated as the lower of the period of membership or the 12 months preceding the month of death. It is important to identify the scale of assurance benefit available. The assurance benefit under the EDLI scheme applies to employees who have remained in continuous employment in Provident Fund registered establishments for the 12 months preceding the month of death. Effective from 15 February 2020, the minimum assurance benefit payable under paragraph 22(3) of the EDLI scheme has been fixed at 2.50 lakh rupees. As per 237th CBT in February 2025. A minimum life insurance benefit of 50,000 rupees will be provided in cases where an EPF member dies without completing 1 year of continuous service. Also, a gap of up to 2 months between 2 spells of employment will now be considered as continuous service, ensuring eligibility for higher quantum EDLI benefits. The maximum assured amount under the EDLI scheme has been increased from 6 lakhs rupees to 7 lakhs rupees. This increase became applicable from 28 April 2021. Previously, a minimum average balance in the Employee Provident Fund account was required for eligibility to receive the assurance benefit. However, this requirement was removed, effective from 1 April 1993. Now, regardless of the balance in the account, the assurance benefit applies depending on the period in which the employee's death occurred. The assurance benefit calculation also takes into account the sum total of contributions made by both the employee and the employer, due up to the relevant period, whether these contributions have been paid or not. Additionally, any applicable interest is considered. When determining the 12-month period for the benefit, it is computed backwards from the month preceding the member's death. In cases where no contributions are payable due to situations like lockouts, closures, or leave without pay, the balance from the previous month is repeated. Interest is calculated up until the month before the member's death. The amount standing to the member's credit on the last date of each month is considered the balance for that month. Importantly, any voluntary contributions made by the employee will also be included in calculating the assurance benefit. Different length of contributory service i.e. less than 12 months or more than 12 months are regulated by different provisions of Para 22. As per 237th CBT in February 2025. A minimum life insurance benefit of 50,000 rupees will be provided in cases where an EPF member dies without completing 1 year of continuous service. The assurance benefit is calculated based on the average balance in the account of the deceased during the 12 months preceding death, or the total period of membership, whichever is less. If the average balance exceeds 50,000 rupees, an additional 40% of the amount above 50,000 rupees is added to the benefit, with a maximum ceiling of 1 lakh rupees. The average balance includes both the employee's and employer's shares, whether paid or payable, along with applicable interest up to the month of death. In cases where an individual holds multiple accounts due to part-time employment, the aggregate of all account balances is taken into consideration. Special checks in settling Form 5 if, first, it's important that all employees are covered under the EDLI scheme, and no exemption or relaxation should be issued for any establishment or employee. In case of any doubt regarding the nomination, the original nomination form should be called upon. The specimen signature of the authorized official, duly attested by the employer, must also be provided. Additionally, signatures on the claim form should match the specimen signature on file to ensure authenticity. The assurance benefit under the EDLI scheme is calculated as follows. It starts with the average monthly wages drawn by the employee, subject to a maximum of 15,000 rupees, during the 12 months preceding the death. This amount is then multiplied by 35, with a maximum benefit of 5,25,000 rupees. Additionally, 50% of the average balance in the Provident Fund account over the same 12-month period or the membership duration, whichever is less, is added. This portion is subject to a ceiling of 1,75,000 rupees. Therefore, the minimum assurance benefit is set at 50,000 rupees for service less than 1 year, 2,50,000 rupees for service more than 1 year, and the maximum benefit can go up to 7 lakhs rupees. In certain cases, the EDLI scheme extends coverage to employees who may not be actively working but are still considered in service. For employees in seasonal establishments, if a member is not receiving a retaining allowance but their name remains on the muster rolls, and they pass away during the off-season, it is treated as a death in service. If a member leaves a covered establishment without withdrawing their Provident Fund accumulations and joins another covered establishment after a short period, any death occurring in the intervening time will be considered as death in service. Similarly, if an employee is on leave without pay or absent for other reasons, but their name remains on the muster rolls, they are still eligible for the assurance benefit should they pass away during this period. The assurance benefit is not contingent on the payment of contributions for every employee. Lastly, in cases of death during suspension or a lockout period, it is still considered a death in service. Even if an establishment has not completed the procedural formalities of closure, the employees are deemed to be in service. As per 237th CBT in February 2025. A minimum life insurance benefit of 50,000 rupees will be provided in cases where an EPF member dies without completing 1 year of continuous service. Also, a gap of up to 2 months between 2 spells of employment will now be considered as continuous service, ensuring eligibility for higher quantum EDLI benefits. Delegation of power by the Central Board. Let's delve into the administrative powers of the Central Board. Sanctioning expenditure. The Central Board has the authority to delegate the power to approve expenditures for contingencies, supplies, and other necessary purchases to either its chairman, the commissioner, or both. This is crucial for the smooth administration of the insurance fund. Appointment of officers and employees. Additionally, the Central Board may empower the chairman or the commissioner to appoint officers and employees. This power specifically pertains to positions that are not covered under subsections 2 and 3 of Section 5D of the Act. It's designed to ensure the efficient administration of the scheme. Each year, before the first fortnight of February, the Commissioner is responsible for presenting a budget to the Central Board. This budget outlines the probable receipts, which include contributions and the levy of administrative charges, as well as the expenditures proposed for the upcoming financial year. Let's discuss the budget approval process. The budget, once approved by the Central Board, will be sanctioned by the central government within a month. The central government reserves the right to make modifications during this process. Additionally, the Commissioner has the authority to reappropriate funds within the sanctioned budget, ensuring flexibility in the allocation of resources where needed. Now, let's focus on the investment guidelines for funds. All money standing to the credit as of 31st March 1997 must be deposited in a public account with a return on investment, or ROI, of no less than 8.5%. For funds post-March 31st, 1997, these are to be invested as per the notified investment pattern of the Employees' Provident Fund, or EPF, scheme. The contributions received from employers and the central government, as specified under subsection 4 of Section 6C of the Act, will be credited to a separate account known as the Insurance Fund Central Administration Account. All expenses related to the administration of this scheme, except for the cost of benefits provided under the scheme, will be met from this account. Let's now review the provisions under Section 17 of the Act regarding exemption from the scheme provisions. First, for establishment, under Section 17, 2A, The Central Provident Fund Commissioner, or CPFC, oversees the administration. Next, the class of employees, under Section 17, to be, is managed by the Additional Central Commissioner, or ACC, or the ACC at headquarters. Finally, for an employee, under Section 17, to be, the responsibility lies with the Regional Provident Fund Commissioner, or RPFC, as per paragraph 28 of the EDLI scheme. This applies to both individual employees and a class of employees. Let's take a look at the key points related to employee contributions and exemptions. First, employees are not required to make any separate contributions or payments of premiums. The benefits provided, whether linked to their Provident Fund deposits or not, are in the nature of life assurance. Additionally, these benefits must be more favorable than those provided under this scheme. It's important to note that no employee can be granted an exemption or apply for one more than once on each account. Lastly, under paragraph 28(4) of the EDLI scheme, the authority to grant exemptions to a class of employees from the provisions of the scheme has been delegated to the Additional Central Commissioner, or ACC, at the zonal level. Next, let's discuss the consequences of non-compliance under the scheme. Failure to submit returns, statements, or documents, or any attempt by an employer to deduct from the wages of a member, whether partially or entirely, the employer's contribution, is a serious violation. Additionally, obstructing an inspector or failing to produce records when required is also an offense. These actions are punishable with imprisonment, extendable up to 1 year, or a fine of up to 25,000 rupees, or both. Thank you for watching. You can access many more interesting topics and test series related to your examination in our bouquet of programs which cover all the relevant topics in detail.